Attention all households across the United Kingdom, because a massive shakeup to the Department for Work and Pensions payment schedule has officially triggered a series of early deposits this April 2026. And if you are not tracking your bank account today, you could be left in a serious financial lurch. We are currently navigating a high-stakes month where the standard rules of the benefits system have been thrown out the window due to the Easter bank holiday weekend and the rollout of the new financial year rates. If you were expecting your money to arrive on Good Friday or Easter Monday, you need to stop what you are doing and check your balance right now, because the government has officially moved millions of payments forward to ensure no one is left without cash over the 4-day break. This shift affects every major support pillar, from universal credit and the state pension to personal independence payment and disability living allowance, and the timing of these changes is absolute. If you miss the window to verify your payment, you could find yourself waiting through a long weekend with zero access to your essential funds while the cost of living continues to bite. You must understand that the authorities are not just changing the dates, they are also implementing a massive digital overhaul of how these payments are tracked, and any discrepancy in your online journal could lead to a permanent suspension of your claim. The headline news for April 2026 is the official confirmation that any payments originally scheduled for Friday, April 3rd or Monday, April 6th have been brought forward to Thursday, April 2nd, 2026. This is a massive administrative undertaking by the Department for Work and Pensions and Revenue and Customs to protect the spending power of 24 million claimants. Because banks are strictly closed on Good Friday and Easter Monday, the system is programmed to release funds on the last working day before the holiday begins. This means that if you are a pensioner whose payment date corresponds to a Friday, or a universal credit claimant whose assessment period usually ends in the first week of the month, your money should already be in your account. However, you must be extremely careful, because while getting your money early feels like a bonus, it means your next payment will not arrive for an even longer period than usual, and you must budget every single penny to make it through to May without falling into debt. The gap between your early April payment and your standard May deposit could be as long as 35 days for some households, which is a dangerous trap if you spend that money as soon as it arrives. But the payment dates are only one part of the story, because April 2026 marks the official start of the new benefit rates, and the increases are more significant than anything we have seen in recent years. As of April 6, 2026, the state pension has officially risen by 4.8% in line with the triple lock and average earnings growth, which brings the full new state pension to £241.30 every single week. This is an essential boost for millions of retirees who have been struggling with the high cost of energy and food, but you must ensure that your first full payment in May reflects this new amount. For those on the basic state pension, the rate has increased to £184.75 per week, and it is vital that you check the exact day of your payment based on the last 2 digits of your national insurance number. If your digits are 00 to 19, you are paid on Mondays, whereas 80 to 99 are paid on Fridays, and this determines exactly when you will see the first uplifted amount in your bank statement. At the same time, universal credit standard allowances are seeing a massive uplift of 6.2%, which is well above the standard inflation rate. For a single person aged 25 or over, the monthly standard allowance has jumped from £400.14 to £424.90, while joint claimants over 25 are now receiving £666.97 per month. These figures represent a significant victory for campaigners who have been pushing for better support for low-income families, but they come with a heavy set of new conditions. The government has confirmed that the 2-child limit has finally been removed as of April 2026, meaning families with 3 or more children will now receive an extra child element for every additional child, which could be worth hundreds of extra pounds every single month. This is a life-changing update for many, but you must ensure your online account reflects your correct family circumstances to trigger the automated payment. While many are seeing their income rise, there is a brutal new reality for those entering the system this month, because the health-related element of universal credit has been slashed for new claimants. From April 6, 2026, if you are making a new claim for the limited capability for work and work-related activity element, you will only receive £50 per month which is a staggering reduction from the previous rate of £94. The government is branding this as a move to encourage more people back into the workforce, but for those with genuine health barriers, this represents a massive financial hit that is designed to save the taxpayer billions over the next decade. If you are an existing claimant, your rate is currently frozen, but you must stay vigilant and ensure you do not have any breaks in your claim, or you could find yourself moved on to this new lower rate, which would cut your additional support by nearly half. This freeze is scheduled to remain in place until 2029, which means your purchasing power will slowly erode as other costs continue to climb. We are also seeing the launch of the brand new Crisis and Resilience Fund, which officially replaces the old Household Support Fund as of this April. This new scheme is being administered by local councils and is designed to provide immediate cash-first support to low-income households who have experienced a sudden financial shock. Unlike the previous system, this new fund is not strictly limited to those on benefits, and councils have been given the discretion to help anyone they deem to be at risk of entering a crisis. The fund includes two separate tiers of support, which are a crisis payment for those with immediate needs and a housing payment aimed at helping with rent deposits or moving costs. If you are struggling to afford the essentials this April, or if the change in payment dates has left you with a gap in your budget, you should contact your local authority immediately to see if you qualify for a grant. The housing payment is particularly important as it can cover a shortfall in rent or a lump sum associated with moving house, but it is strictly restricted to those already receiving housing benefit or the housing element of universal credit. For those on legacy benefits like employment and support allowance or housing benefit, the clock is ticking faster than ever because the Department for Work and Pensions has confirmed that the migration to universal credit must be completed for most people by the end of the summer 2026. If you receive a migration notice in the post this month, you cannot afford to ignore it, because if you fail to make the move within the 3-month window, your current benefits will be stopped permanently on April 1, 2026 for many types of claims. The government is pushing for a total digital transformation of the welfare state, and they are using every administrative tool to ensure all claimants are on the same streamlined system. There is a small extension for approximately 4% of vulnerable claimants who have serious medical barriers, but for everyone else the deadline is absolute. If you claim before your deadline, you could be entitled to transitional protection, which ensures you are not financially worse off than you were on your old benefits. But if you miss that date, you will lose that protection and potentially hundreds of pounds in monthly income. Beyond the administrative changes, the energy price cap has also shifted this April, dropping to £1,641 for the average household, which provides some much-needed relief as the weather begins to turn. This is a decrease of 6.6% compared to the start of the year, and it is largely thanks to the removal of green levies from customer bills as part of the autumn budget. However, you must remember that the cap only applies to unit rates, so if you live in a larger house or use more energy than average, your total bill will still be much higher. The standing charges have also changed, with electricity charges rising to 57 pence per day, while gas standing charges have dropped to 29 pence. This means that even if you use zero energy, you will still be paying a significant amount just to stay connected to the grid. The next price cap announcement is scheduled for May 27, 2026, and predictions suggest that prices could rise again in the autumn, so you must use this temporary dip in costs to build up a small buffer in your energy account. For drivers, the rules of the road are also undergoing a massive transformation this month, with the vehicle excise duty rates climbing in line with inflation. Most drivers will see their annual tax bill rise by around £5, but those buying high-emission vehicles will face a showroom tax of up to £5,690. However, for electric vehicle owners, there is a significant win, as the luxury car supplement threshold has been raised from £40,000 to £50,000, which means fewer people will be hit with the £440 surcharge for the next 5 years. Additionally, from April 6, 2026, the benefit-in-kind tax for electric company cars is rising from 3% to 4%, which will slightly increase the monthly tax paid by employees using these vehicles. You also need to be aware of the new rules for driving tests, because as of this spring, only learners themselves can book their tests, and you are strictly limited to only 2 changes to your date or location before your booking is canceled entirely. The Department for Work and Pensions is also ramping up its enforcement of the Fit for Work regulations with more intensive reviews for those claiming health-related benefits. If you are currently in the Limited Capability for Work group, you can expect a review letter this year as the government attempts to move more people back into employment. To support this, they have increased the national living wage to £12.71 per hour as of April 1, 2026, which is a 4.1% increase. For younger workers aged 18 to 20, the rate has seen an even bigger jump to £10.85, which is an 8.5% rise. These increases are designed to make work pay and reduce the reliance on state support, but for many, the rising cost of rent and utilities means that even a full-time wage at the new higher rate is barely enough to cover the essentials. You must stay vigilant and keep your online journal updated because the Department for Work and Pensions is using artificial intelligence to flag suspicious claims, and any inconsistency in your reported income or living arrangements could trigger a full investigation. The use of automated systems for debt recovery is also increasing, which means if you have an outstanding overpayment from years ago, the government could begin deducting it from your new April rates without warning. Check your statements carefully, and if you notice a deduction you do not understand, you must call the helpline immediately to set up a manageable repayment plan. The system is becoming more efficient, but it is also becoming more cold and automated, and the burden of proof is increasingly placed on the claimant to ensure every detail is correct. April 2026 is a total reset for the United Kingdom's financial landscape, and whether you are a pensioner, a worker, or a benefit claimant, you are currently standing at a crossroads. The early Easter payments were a temporary relief, but the new rates and the stricter migration deadlines are the permanent reality for the rest of the year. You need to verify your national insurance digits, calculate your new monthly income, and ensure you are taking advantage of every local council grant available. The margin for error is zero, and the cost of missing a deadline has never been higher. Stay alert to the changes in your bank account, and make sure you have a solid plan for the long gap between your early April payment and your regular May deposit. The government is moving fast to overhaul the entire welfare and transport systems, and only those who stay one step ahead of the paperwork will thrive in this new environment. Take the time today to log into your accounts and secure your financial future, because once the deadline passes, there is no going back to the old rules of the road or the old rates of support. As we move deeper into the spring, you should also keep an eye on the fuel duty freeze, which is officially scheduled to end in September 2026. For over a decade, the government has kept a lid on the tax paid at the pump, but those days are numbered, and once the freeze ends, we could see petrol and diesel prices jump by at least 5 pence per liter overnight. This is all part of the broader strategy to force a shift toward electric vehicles and more sustainable forms of transport. At the same time, the new driving theory tests are now including questions on life-saving skills like CPR and the use of defibrillators, which reflects a growing focus on public safety and health on the roads. Every aspect of our daily lives, from how we get to work to how we receive our income, is being redesigned for a digital and post-inflation era. The importance of staying connected to official government channels cannot be overstated because the rules for the new Crisis and Resilience Fund and the Universal Credit Health elements are being updated in real time. If you find yourself in a position where you cannot pay your rent or afford food because of a delay in your payment, you must use the official DWP helpline at 0800-1690310. There is also a dedicated support network for those struggling with the managed migration to universal credit, which includes a separate budgeting loan program worth over £1 billion. Do not suffer in silence if the system fails you, because there are emergency protocols in place to ensure no one is left entirely without support. However, you must be the one to initiate the contact and provide the necessary evidence to trigger these emergency payments. In conclusion, April 2026 is a month of massive transition for the British public. The early Easter bank holiday payments served as a wake-up call for many, but the real challenges lie in the new benefit rates, the stricter health element rules, and the final push for managed migration. Whether you are driving an electric car or relying on the state pension, the landscape has shifted beneath your feet. Check your documents, verify your dates, and budget with extreme care to bridge the gap created by the bank holiday schedule. Your financial stability depends on your ability to navigate this complex web of new regulations and higher costs. Stay safe, stay legal, and make sure you are getting every penny of the 6.2% uplift that you are entitled to. The future is digital, the rules are stricter, but for those who stay informed, the opportunities to secure a better financial footing are there for the taking. This is your guide to the changes happening right now across the United Kingdom, and taking action today will ensure you are not the one left behind in the wake of these historic reforms. The Department for Work and Pensions has also hinted at further changes to the Work Capability Assessment later this year, which could affect those with mental health conditions. This is part of the ongoing effort to reduce the number of people on long-term sickness benefits and increase the labor supply. If you are in this group, you should begin gathering your medical evidence now to ensure your claim is protected when the new assessments begin. At the same time, the expansion of free childcare for working parents is reaching its final stage this April, allowing more families to access up to 30 hours of free care for children as young as 9 months old. This is a massive win for parents trying to return to work, and it coincides perfectly with the rise in the national living wage. However, you must reconfirm your eligibility every 3 months to keep your code active, or you will be hit with the full cost of childcare, which could easily wipe out any gains from your pay rise. As we look toward the summer, the message remains the same, which is absolute vigilance. The energy cap will be reviewed again, and the final notices for legacy benefit migration will be sent out. Make sure your mailing address is up to date with the DWP, because if a migration notice is sent to your old house and you do not see it, your benefits will stop, and you will have no way to get them back without starting a brand new claim from zero, which would mean losing any transitional protection. This is a high-stakes game of administrative follow-through, and you are the primary player. Keep your eyes on your post, keep your ears open for new announcements, and keep your digital accounts secure. April 2026 is just the beginning of a very busy year for the UK economy and the welfare state. By following these steps and staying informed, you can navigate these changes with confidence and ensure your household remains secure regardless of what the government announces next. Stay informed and take control of your financial destiny today.